Just this week, we've seen another failed breakout by gold, and now Deutsche Bank announced that a growth recovery and higher treasury yields means that there's more probability of gold hitting $1,600 rather than rising to $2,100. Today, we explore this argument, so let's dive on in. Now, this channel provides global macro insights and champions the importance of sound money in a world gone crazy. So please do consider subscribing. So let's start by examining the arguments put forward by Deutsche Bank that firstly, bond yields are ticking upwards, and this is certainly true. And we can see this with the popular ETFs such as TLT, the iShares 20+ year Treasury Bond ETF, generating negative returns over the last 6 months. At the same time, the SPX S&P 500 index has generated significant gains. Clearly, the market has been taking a risk-off approach in recent months, and there is clearly a risk for gold that central banks are in the process of starting a new credit bubble, which could diminish demand for risk assets. Indeed, gold ETF inflows have begun to dry up, as Deutsche Bank highlight in this chart, which were particularly strong in the period from April through to August, which coincided with gold hitting its all-time highs. Moreover, the news of a successful vaccine earlier this week caused a massive rotation of assets towards risk-off and led to gold's largest decline in 7 years, no doubt aided by bullion banks in their desperation to cover short positions. And this raises another point of interest that James Turk highlighted this week, that each time gold has raised its head above the parapet, it has been quickly shut down, as he states that today was another win for the central planners in their ongoing war against gold. They've chalked up 5 in a row. Each break of a downtrend line was stopped to put gold back into the support zone. Shorter-term risks are also apparent, as there are clear market risks in the period prior to the US inauguration on January 20th. There is also the prospect of Bitcoin nibbling away at some of gold's market share, as JP Morgan stated that even a modest crowding out of gold as an alternative currency over the longer term would imply doubling or tripling of the Bitcoin price from here. And with the news that billionaire hedge fund manager Stan Druckenmiller has now invested in Bitcoin, there seems a lot of momentum behind this asset. But let's put things into perspective. Just 1 year ago, in November 2019, gold was at $1,455 an ounce. Today, we're trading at around $1,880 an ounce, a 28.5% gain. In fact, since the end of 2018, gold is up around 46%. This is clearly highlighting longer-term, more fundamental macroeconomic weaknesses that were growing within our economic systems, and we've talked about extensively on this channel. And while a growing number of hedge fund managers are investing in Bitcoin, central banks are yet to do so. And as former Vice President of the Fed, John Exter, said, a cardinal rule of international finance is to pay more attention to what central bankers or governments do than what they say. And we know central banks continue to hoard gold. And to that end, central banks' primary and highest quality assets on their balance sheet continues to be gold. And if we use traditional indicators such as the Dow Gold ratio, we are now at a ratio of 15.8 to 1. Now, we've discussed this Dow Gold ratio previously in this video, where history tells us that right now gold, even at current prices, is undervalued in relation to stocks. And just check out the Buffett indicator here of corporate equities to GDP at another all-time high. The stock market is delusional, and that goes too for Deutsche Bank's expectations of a rapid recovery in 2021. Likewise, the World Bank stating that global growth at 4% in 2021 seems farcical when they also admit to a global debt tally of $260 trillion. Do Deutsche truly believe will we see a firm recovery that blows away all risk? I remain extremely doubtful of this, with lockdowns continuing across Western Europe and the threat of these returning in North America. Austrian economist von Mises noted that all periods of government-induced credit expansion must end in an economic crisis. After all, in ending a credit-fueled boom, a government and its central bank can adopt a period of quantitative tightening, which was attempted by the Fed, but as markets began to fall, they quickly reversed that policy, and so they are now left with currency debasement. This is the option being undertaken by almost all central banks globally. Sven Heinrich recently put out an excellent recent tweet stating that the greatest trick the devil ever pulled is to convince people that permanent intervention and unlimited debt expansion is consequence-free and can be a substitute for structural growth. What's more is that these balance sheets will continue to soar as Western economies' deficits continue to reach new highs, and this adds more debt to that already amassed. So more QE will be coming to enrich the big banks and ramp up inequality between the asset poor and the asset rich. And remember, we've previously discussed how many perceive that the number one driving force behind gold prices is the expansion of the Fed's balance sheet. This is, of course, in a world of zero or near zero interest rates. Additionally, any potential recovery that we have seen suggested by the rising oil price this week has the very real prospect of generating higher inflationary pressures. The impact will be to negate rising nominal bond yields and send the real yields lower. Moreover, it's not as if bond yields simply collapsed in the last gold bull market. This chart shows us the 10-year Treasury yield rate rose from the end of 2008 through to 2010. At the same time, gold prices rose from around $750 an ounce to almost double. And when we factor in the extent of gold's recent consolidation, ETF flows drying up, and gold's historical seasonal performance, which highlights how gold often performs strongly from late November through to February, I would sense that we cannot be far away from a new breakout in gold. But as we saw in a previous market update where we looked at Herbert Muhlmann's fractal analysis of the gold market, we are challenging these levels from gold's previous nominal high of 2011. It is little wonder that we face so much resistance at this level. After all, it's a level which could potentially lift the lid and send metals prices screeching higher in what could soon become a complete monetary collapse. And just to put that into context, just look at this excellent graph planning out 3 scenarios from the In Gold We Trust reports for the M2 money supply. All of these are immensely bullish for gold. And if we apply the mania model, or the potential future bubble we'll see in the gold and silver market, we can very much expect it to follow this sort of pathway. And so where are we now? With the macro trends as clear as they are and the need for a new monetary reset, is there even a possibility that we could be in a bull trap after the all-time highs of the summer? Well, Nick Laird of Gold Charts R Us sees it more like this. Here we have the silver price on the left and the gold price on the right, with his model anticipating gold going to somewhere near 6,000 and silver above 3 figures around 2024. Clearly, patience remains key. So as the world faces future economic chaos and a monetary reset, owning precious metals offers us the security we truly need in the most uncertain of times. It's also worth considering the extent to which you trust Deutsche Bank. What exactly is more trustworthy, Deutsche Bank and their ulterior motives, or gold and silver? Because this show will end, and when it does, it will end badly. At that time, I will want to have some cash to hand and hard, safe assets that have little to no counterparty risk. Thanks so much for watching. Let me know what you think in the comments below. and I look forward to seeing you next time. Bye bye.